Welcome to the wildest week in crypto, where Bitcoin stumbled, Ethereum soared, and the market felt like a caffeinated roller coaster. Bitcoin, the grumpy king, took a nosedive while Ethereum shot up on ETF rumors. We saw a historic Bitcoin mining event and a $9 billion Bitcoin sale that could buy every Beanie Baby ever made Wall Street titans. Once skeptics are now diving into crypto and the government is chiming in with new policies and wild proposals. The Federal Reserve held rates steady, and President Trump floated a plan for a U.S. Bitcoin reserve straight out of sci-fi. This week was a perfect snapshot of crypto, exhilarating, terrifying, and profoundly weird. Buckle up as we break down the chaos, the power plays, and what it all means for the future of money. Let's start with the main event, price action. Bitcoin, the supposed safe haven, dipped below $95,000, rattled by profit-taking and economic jitters. Meanwhile, Ethereum rocketed past $6,500, fueled by rumors of imminent ETF approval. Investors piled in, eager to front-run institutional money. Ethereum decoupled from Bitcoin's gloom, charting its own bullish path. And XRP, still stuck in its legal limbo, trading sideways, unmoved by the surrounding drama. Its performance is a reminder that regulatory clouds can pin down even major assets. This week, Bitcoin's dip showed the market's fragility. Ethereum's surge highlighted the power of institutional adoption, and XRP's stagnation was a lesson in regulatory risk. 3 coins, 3 stories, each telling a different tale of the week. The market was a patchwork of divergence, with every corner moving to its own beat. If you blinked, you missed a plot twist. That's crypto. Now let's peek behind the curtain at Bitcoin mining. This week, Bitcoin's network saw one of its largest ever downward difficulty adjustments. Why? A massive drop in hash rate thanks to extreme weather in mining hubs like Texas, forcing miners offline. The result, mining got easier, and the remaining miners suddenly found themselves in a much more profitable position. It's like showing up for a marathon and finding out it's now a 5K with double the prize money. This event highlights both the resilience and the vulnerabilities of Bitcoin's infrastructure. The system worked as designed, but it also showed how concentrated mining has become in certain regions. For a network built on decentralization, that's a wake-up call. The takeaway? Bitcoin's self-regulation is brilliant, but its physical roots are more fragile than they seem. Even a heat wave can shake the world's biggest cryptocurrency. This week, in a transaction that underscored the scale of institutional involvement in crypto, Galaxy Digital facilitated a jaw-dropping $9 billion Bitcoin sale. It's a figure that would have been unimaginable just a few years ago, highlighting the maturation of the digital asset market. This was an over-the-counter deal of immense proportions, and it sent ripples throughout the market, causing many to reassess their positions. The sheer size of the transaction was enough to shake even the most seasoned traders. The identity of the seller remains shrouded in mystery, fueling speculation and intrigue within the crypto community. Who could possibly part with such a vast quantity of Bitcoin? While concrete details are scarce, speculation points to a sovereign wealth fund looking to rebalance its portfolio, or perhaps a mega whale finally cashing out after Bitcoin's impressive run-up in value. The possibilities are endless, but the impact is undeniable. This massive sale undoubtedly contributed to Bitcoin's recent price dip, triggering a wave of selling pressure across various exchanges. The market reacted swiftly, demonstrating its sensitivity to large-scale transactions. Meanwhile, in a contrasting narrative, BlackRock's Bitcoin ETF continued its quiet but steady ascent, attracting significant investment and solidifying its position as a leading player in the space. The ETF has been attracting billions in steady inflows, signaling strong institutional demand for regulated Bitcoin exposure. This influx of capital provides a counterbalance to the selling pressure from large holders. It's a battle. A clash between old money whales executing blockbuster moves that can momentarily sway the market. This is versus the slow, but relentless and ultimately more powerful tide of institutional ETF buying, representing a long-term commitment to Bitcoin. This ongoing tug-of-war between these opposing forces is a key factor driving the increased volatility we're currently witnessing in the Bitcoin market. The market's behavior is now largely defined by these two dominant forces. On one side, giant, often secretive sellers capable of executing massive sell orders, and on the other, the increasing mainstreaming of crypto through regulated investment products like ETFs, opening the door to wider adoption. Every big move, especially those from the large sellers, sends immediate shockwaves throughout the market, but the steady and consistent ETF inflows are fundamentally changing the game, providing a more stable foundation for future growth. So, what does the future hold? We're likely heading towards a market increasingly shaped by both the old guard of traditional finance and Wall Street's new crypto converts who are bringing unprecedented levels of institutional capital into the digital asset space. And for now, we're all just along for what promises to be a very interesting ride, filled with both opportunities and challenges. Crypto doesn't exist in a vacuum. Its fate is intertwined with the broader economic landscape, influenced by decisions made in the halls of power and the boardrooms of central banks. Central banks and politicians are always in the mix, wielding considerable influence over market sentiment and regulatory frameworks. Their actions can send ripples through the crypto sphere, impacting everything from price volatility to long-term adoption. The Fed held interest rates steady, a decision that was widely anticipated by the market. This signaling caution and keeping risk assets like crypto in a holding pattern, as investors await further clarity on the future direction of monetary policy. The market is essentially taking a breather, assessing the potential implications of the Fed's stance. No hike is good, at least in the short term, as it removes the immediate pressure of increased borrowing costs. But higher for longer rates make bonds more attractive than Bitcoin for some, particularly institutional investors seeking stable returns in a risk-averse environment. The allure of fixed income can temporarily dampen enthusiasm for more speculative assets. The real shocker: Donald Trump proposed a US Bitcoin reserve, a move that sent shockwaves through both the crypto and political worlds. He's suggesting the Treasury should buy Bitcoin as a strategic asset, potentially diversifying the nation's holdings and embracing the digital age. Supporters called it visionary, saying it could legitimize Bitcoin on a global scale and spark a bull run of unprecedented proportions. The endorsement from a major political figure could be a game changer. Critics warned it's reckless to back the dollar with such a volatile asset, arguing that it could destabilize the economy and erode confidence in the US financial system. Either way, Bitcoin is now a campaign issue, whether people like it or not. It's been thrust into the political spotlight, forcing candidates and voters alike to grapple with its implications. These macro moves set the stage for everything in crypto, influencing investor behavior and shaping the regulatory landscape. The Fed controls liquidity, which directly impacts the availability of capital for investment in all asset classes, including crypto. And political winds could reshape regulation and adoption overnight, creating both opportunities and challenges for the crypto industry. The fact that a presidential candidate is pitching a national Bitcoin strategy, something that would have been unthinkable just a few years ago, shows how far crypto has come in its journey from a niche technology to a mainstream asset class. It's no longer if governments will engage with crypto, that's a foregone conclusion at this point, but how and when they will do so remains the critical question, with significant implications for the future of the industry. The stakes have never been higher, as the decisions made today will shape the future of finance for generations to come, and the world is watching, eager to see how this drama unfolds and what it means for the global economy. Beyond Bitcoin and Ethereum, altcoins had their own fireworks. Avalanche, AVAX, surged on new partnerships and its push to tokenize real-world assets, positioning itself as a next-gen finance platform. Chainlink, Link, rallied on news of its cross-chain protocol, cementing its role as the go-to oracle for connecting blockchains to real-world data. And then there's Pepecoin, Pepe, the meme coin that soared on pure hype and internet energy, no fundamentals required. These moves show the market's diversity. Serious tech plays like Avalanche and Chainlink, and casino-style speculation with meme coins. Both can be wildly profitable and risky. The altcoin space is a microcosm of crypto's extremes: innovation, speculation, and a dash of absurdity. Whether you're a tech investor or a meme chaser, there's something for everyone. This week proved that in crypto, the only constant is surprise, and fortunes can change in a tweet. While prices swung, DeFi quietly kept building the future of finance. The big story capital flooding into Ethereum-based liquid staking and restaking protocols. With Ethereum ETFs looming, investors are staking ETH for yield, and using protocols like Lido and Eigenlayer to earn even more. Restaking lets users secure multiple networks with the same ETH, stacking rewards and risk. The anticipation of yield-bearing ETFs has driven a frenzy of pre-positioning in DeFi. This is no longer a niche playground. It's a sophisticated, high-stakes arena. DeFi's core innovation open, composable financial products for anyone, anywhere. The growth in restaking and institutional interest in staked ETH shows DeFi is maturing fast. The nerds are building a new Wall Street, one block at a time, and the world is starting to notice. Alright, let's dive into the exciting world of cryptocurrency charts. We're going to break down the technical landscapes of Bitcoin, Ethereum, and XRP. These charts offer a glimpse into the potential future movements of these digital assets. So, let's get started. First up, Bitcoin. And right now, Bitcoin looks bearish. The chart is painting a picture of potential downside. It's currently testing the crucial $92,000 support level. This is a key area to watch. A bounce from this level could signal a recovery, offering bulls a chance to regain control. But a break lower spells trouble, potentially leading to further declines. Now, let's shift our focus to Ethereum. Ethereum is the star of the show, blasting through resistance with impressive momentum. It's now eyeing $7,000 as its next target and potentially forging new all-time highs. The bulls are definitely in charge here. As long as it firmly holds $6,200 as a support level, the bulls are firmly in control, suggesting further upside potential. The ETH-BTC ratio is key to understanding the relative strength between these two giants. As long as this ratio continues to climb, Ethereum is expected to outperform Bitcoin, offering potentially greater returns. What about XRP? Well, it's still stuck between 58 cents and 65 cents, trading sideways without a clear direction. It's patiently waiting for a legal breakthrough in its ongoing case. A positive resolution could be the catalyst it needs to finally break out of its frustrating range. For XRP, its price action is less about what the charts are saying and more about what's happening in the courtrooms. In summary, let's recap the key takeaways from our chart analysis. Bitcoin is currently on defense, facing potential downside pressure. Ethereum is on offense, displaying strong bullish momentum and breakout potential. And XRP is unfortunately in limbo, awaiting a catalyst to spark movement. Given these diverse market conditions, traders need asset-specific strategies to navigate effectively. What works effectively for ETH with its bullish momentum could potentially flop for BTC, which is currently exhibiting a more cautious stance. It's a divided and volatile market demanding careful consideration and adaptability. For those who thrive on action and rapid price movements, it's a playground filled with opportunities. But for everyone else, it's crucial to buckle up and prepare for potential turbulence. The technicals tell a compelling story of a market at a crossroads, with each asset facing its own unique challenges and opportunities. And the next move, particularly for Ethereum and potentially XRP, could be explosive, so stay tuned and keep a close watch on these markets. After a week of chaos, what's next? The community is cautiously optimistic, especially about Ethereum. The big bet SEC approval of spot Ethereum ETFs could trigger another explosive rally. For Bitcoin, opinions are split. Some see a recovery as ETF inflows build, others fear more big sales ahead. The $92,000 support is the line in the sand. Watch for ETF inflows, Trump's Bitcoin reserve proposal, and DeFi's continued growth. The market is at a crossroads. Bitcoin under pressure, Ethereum euphoric. The SEC's decision on ETH ETFs is the main event. In crypto, the only certainty is volatility. Next week, expect the unexpected.